All right, this month I'm interviewing with Ray Aguilar. I believe you're Vice President of Lending, and that's still true? That's what's on the website at United Bank. And right now, United Bank, you're consistently one of the tops, aren't you, in El Paso?
Yes.
How many loans do you guys do normally?
Are you doing just business loans?
Business loans, yeah.
In general? Quite a bit. I mean, and then the categories range from, because when we started the bank to for professionals, but with that we branched out to small business, and that's always been an area where I think we've excelled. But altogether, as far as with loans themselves, as a whole, you're talking about all of them altogether, both SBA, real estate. Boy, I'd want to say just at the top of my head, without getting those numbers. I could actually get you some detailed numbers.
Yeah, just close.
I would say easily probably 150, 200 loans.
And you guys are consistently, aren't you, number one with the SBA loans in the city?
Yeah, we for the last 7 years in the categories, in terms of actual volume, we for the last 6 years, we've been the number one lender in that particular category. And of course, in terms of the actual gross amount, that would vary because you have some of these small, those that are doing maybe 504 loans, those are larger loans, and those can go up. So if, let's say for instance, if you have a loan that's say $3 million, you can do a few of those, and before you know it, your gross number is way up there. Yeah. Where we do is we're doing small loans, so to the small business owner. So if you're doing something like, let's say, $250,000 or say $150,000, we do more of those to help the small business individual get up and
So your specialization really is small business.
It is. And remember,
it has been since the start, right?
Right, and really here in El Paso, small business represents $1 million and less in sales. And people don't really understand that, because when you really, even if you look at physicians, most physicians' revenues are less than $1 million.
That's true. Yeah.
So when you look at it from that scale, you can understand that it's that market under $1 million is tremendous. It probably represents 75%,
if not more.
Yeah.
I mean, statistically, I've seen like 95% are under $1 million. So,
yeah.
So I mean that's probably true. Before that, you were with Bank of the West, weren't you?
Yes.
And they did pretty much the same thing. How long were you with them?
About 6.5 years.
So you've been doing small business loans for how long?
Well, even going back further than that, I was with Bank of El Paso.
So you've been doing this pretty much your whole professional life?
Yeah.
So what's changed? One of the things, like I said, one of the things I wrote down in here that I wanted to make sure I talked to you about is I've been hearing arguments, and we've been seeing nationally that banks aren't lending. Has it? I know it's changed, but there's still loans out there. Are you doing dramatically? I guess let me ask the question: are you doing dramatically less than you were in 2008, or has?
Yeah, well, I'll give you an example. I was doing construction lending. I had construction lending to builders. Well, if you look at the market right now, and that goes back to one of your questions: has the market changed? Well, it has. Construction industry. If you look at it right now, especially for builders, we're dealing with a lot of small builders, and even those that were custom home builders, and that market has dried up.
Totally gone.
If you look at the market here, we were doing, or I was doing construction lending to builders that were building homes $350,000 and up. Well, look where that market has gone. It's shrunk. Right now, you're looking at affordable housing, and even that has shrunk. So if you look at over the last 3 years, so yeah, and that's more of a function of economics.
So it's not really a function of the money not being there as much as there's less people.
Right. Well, and then the other thing is too, we're kind of caught in the middle, because the other thing that we have to face is we have to face our regulators. They make it
higher, right?
And they make it difficult upon us.
Has Dodd-Frank affected you?
I'm sorry?
The Dodd-Frank rules and all that, is that part of that, or no?
Yeah, it's all a function of that, So
has it increased your cost plus made it just much more paperwork?
Well, you know what, and there's another example that you mentioned, which I didn't even think about. It is now as banks, we're having to pay more insurance, FDIC insurance, to
which is passed on to the business,
right? Yeah. So the answer to your question is has the market changed? Oh yeah, dramatically. So, and it's not to say that the banks aren't lending. There's still monies that are out there. Now, where we differ is we're a community bank. So, our decisions are made locally. I mean, I can go and bring in a customer and take a director out there to go visit the operation and see how comfortable they feel. Where versus a bigger bank, you might maybe have like a Chase or Wells Fargo, B of A, where their people are basically getting the packages and then their decisions are made elsewhere. Where we know the market. We our board members are actual business owners, so they know the market here in El Paso. So when you're having your package being sent to Houston or Phoenix or wherever it may be, Minneapolis, how can they're looking black and white, they're looking numbers. They're not looking as far as the economy. Our economy is different from Dallas. Our economy is different from Minneapolis, from Phoenix. So
and everybody's economy is different.
Yeah, that's right.
Which is one of the things I was going to lead up to. The advantages of, you've already touched on it, the advantages of working with a local bank as opposed to a national bank. Would you, I know you got a bias in this, but I think I agree with you. From working as a CPA for 30 years, I almost always bring my small businesses to local banks because of that, exactly what you said. The other thing I've seen is turnover is different. Like you've been there since the beginning of that bank.
Right.
Pete's been there. How many of your bankers, I mean, they just don't turn over, do they?
No. I mean, on average, our bankers probably have been there 7 years.
And that's pretty typical of local banks, isn't it? The advantage to the business owner would be then
the stability, and because the thing is, if you're dealing with a lender, you want to make sure that lender is about building relationships, and so he gets to know the business, and so you can go back. And not only that, but it should be the point where you can kick an idea off the lender, and the lender can come back to you and say, and really when you look at it, it's a function of working as a team, between working with a CPA, working with the attorney, working with the insurance agent. Basically, we're always in constant communications with the owner, so that if they're going to come up with an idea, maybe expansion or something like that, you can always run it by them, and that's where the difference.
And that's what I see too. I mean, I've seen that. That's why I've worked with you for all these years too. Is it's a pain in the butt from a CPA standpoint to build a relationship with somebody, especially like at the big banks. And I'll say it: Chase, Wells Fargo, those guys, Bank of America. I'll walk in, I'll be lucky if I see the same guy 2 times in a row. I mean, I might see the vice president, but I'm not going to see them very often. They're not going to come down and look at my size loan.
Yeah. And see, the other thing too also is that we're interested in getting your business, all your business, and we want to be there as your bank. I want to be there as your lender. But with the bigger banks, they are in such a hurry to sell you the products. We want to get you the credit cards. We want to get you the investments. We want to get you the insurance. I mean, that's fine to have the array of products, but it's with them. It becomes with sell. With us, with a smaller bank, and granted we don't have all those products, but the idea is to be able to service needs. And many of the times, the businesses are small enough where they don't need the products, but still they're trying to be hammered in with taking the products. Yeah,
and just another question. Am I writing small? I should have paid attention to that. We went down there. One of the things that I've heard, and I'm kind of jumping ahead on this a little bit, that I've spoken to you before, and I've spoken to other commercial lenders, and one of the common complaints I get from you guys is that probably 90% of the small business owners who walk in to see you just aren't prepared.
Right, that's correct.
Yeah, and I wrote a whole bunch of stuff here, but I'm kind of going out of order, but that's all right. What kind of things do they need to bring to you, and when should they come see you?
Well,
it's really 2 different questions. When should they come see you?
Well, really early on. I mean, at least they need just to establish an account, and then one thing to do is to introduce themselves to the lender. I mean, that I think would probably be just from the beginning. Okay.
Literally when they open their business.
Right. Well, no. I mean, I would say before that.
Really?
Right.
Okay.
Only just because so that they can get an understanding of all banks are different, and they need to understand that where the service is at, because you can get a feel if you go to a bank and they kind of blow you off. Well, then that pretty much is going to set the tone, because chances are they may treat you that same way. And all banks vary, and not only the banks but the individual loan officers. You may have a great loan officer that's very attentive to detail and to the customers, or you have another one that says, you know what, I don't want to mess with a small loan. My clientele is borrowings over $1 million.
Gotcha.
Okay, so that makes a big difference. But in terms of the actual lending, if a business owner is going to start his business, the idea is he needs to understand, the market, who his competition is. Okay, He needs to understand what his business is going to be different from someone else.
Mm-hmm.
Why as as an example, you or yourself, why would there's tons of CPAs.
Sure.
Why come to you? There's
Right.
tons of banks. Why come to my bank? And so they have to be able to differentiate themselves from that. And so, but in doing so, as I mentioned when we talked earlier, if you have someone in the service business and they're good at what they're doing, well, now comes the hard part where they're going to have to wear many of the hats.
Mm-hmm.
So if they come in and they don't know these things, like I'll say an example, like the accounting part, that's really important, because the answers that we don't want to get is when we're answering questions is, well, you know what, talk to my CPA.
Yeah.
That's pretty scary because if they don't know their costs, that's a problem.
Yeah.
So, and then the marketing. We talked a little bit about marketing.
Uh-huh.
How are you going to sell your services? What is going to be best to market your business, whether it's service or manufacturing or distributing, whatever it is. You have to find that particular marketing product that's going to be able to generate sales.
Mm-hmm.
And nowadays, you've got the internet, you've got Facebook,
Mm-hmm.
you've got everything. What is, are you going to advertise? And then of course the other thing is cost.
Mm-hmm.
What budget do you have? So, most people, especially if they're coming out of another business, and that's how most businesses start about. They're
right.
working for someone else, and they want to
I can do it better.
Yeah, they get that entrepreneurial spirit, which is great, and I have a lot of admiration for them. But many of the times they don't have that information, armed with that information to start the business plan. So they come in with us with a business plan, and it's very weak.
Mm-hmm.
But the thing about it, though, is that there is information out there
Mm-hmm.
for them to start their business plan.
And you brought up something I hadn't really thought about. Too many small business owners really act like lone wolves. They're by themselves. They don't
Sure.
get help.
Mm-hmm.
What you're basically saying is that a banker is a key part of their team.
Right.
You should get them from the very beginning, because you can. I've made mistakes. I mean, if somebody would have just said do this instead of that. I always said if I were to start the CPA firm again, what took me 20 years to build, I could do it in 5.
Mm-hmm.
And part of it, I made the same mistakes. I mean, what you're talking about, not getting enough help up front, because I'm a good CPA. I know what I'm doing.
Mm-hmm.
It's different running a CPA firm, and
Right.
it's really kind of where you're headed. So let's go to the second part. Let's say they're ready to go out for a loan. They want to do an expansion, or let's just set up a scenario. They've got a business, they're making a profit, they want to go out and expand. They're looking at possibly an SBA loan. What kind of loans are out there right now?
Well, there's pretty much a array of products, and you want to match the loan with or the product, I should say, with what they're going to need. If they need a real estate loan, there's both conventional loans with the SBA. Their flagship program is a 7A loan, and now there's the 504. I would recommend the 504s because it only requires them to put 10% of the total project cost, which means you can roll in the soft costs such as the appraisal, the title policy, some of those normal fees, where otherwise under the conventional loan, and see, this is where the difference on a conventional loan, most banks require that you have 20% injection, so there's more of a cost there.
Right.
Okay, now if
So they can get in for 10%.
right. Let's say, for instance, if it's equipment financing,
Mm-hmm.
that's another thing. And both, as a bank, we do it conventionally, and we do it with the SBA. It really depends on how strong the individual is. Well, not only that, but the SBA programs to allow you to go farther out for equipment. So
by farther out, you mean longer term.
Yeah, if
which
you
can reduce their payment. Plus, they help you with interest.
Right. So if you have a piece of equipment that's going to last you, 10, 15 years, the SBA program would probably be better in that respect. And not only that, but then you have the interest rate, where right now typically it's 2.25 or prime. Prime right now is 3.25. So you're looking at a initial rate of.
See, for equipment loans, a lot of people are going out and doing leases.
Well, right.
And those, what you see, what's a typical lease interest rate you're seeing now?
Well, it's higher,
Quite a bit higher,
yeah.
right?
And then of course you have to look at the leases, well, and it depends too. I mean, if you're going to buy a phone system, that would at least would be a good thing, because chances are the phone system will be inadequate after 3 or 4 years, or computers.
Right. Yeah, there you go.
So leases do play an important role. It depends on what you're doing. But if you're buying heavy equipment that, as an example, that you're intending on keeping, you've got a maintenance department, and at least might be okay, but you might want to go ahead and finance that. So it all depends on what is it that your appetite is.
And why would I go to the SBA? Why would I go to you instead of going straight to the SBA?
Well, the SBA people don't understand that the SBA, they're only providing the guarantee.
That's what a lot of people do wrong. I
Right.
went to the SBA, they didn't help me.
No, and that's true because and what they'll do is they'll refer them to and this is where I'm saying it's important to establish a relationship with the bank first because they can help you with that area. Because the SBA, the only thing that they're going to do from our standpoint is provide what we call the loan authorization, and it's that comfort feeling saying, okay, that loan, the SBA or the government is guaranteeing that loan 70%, 75%, 90%, whatever it may be, under what program it is. That's all they're doing. But everything, all the underwriting is done through the bank.
Right, so basically you guys make the loan decision, really.
Right, that's correct.
And it pretty often predicated on having the SBA guarantee,
That's
which
correct.
allows you to give a loan you may not give to a small business.
Right. Well, as an example, like that 504, that
Go
504.
into that a little bit more because that's a good program.
Yeah, well, that goes out 20 years. See, we
Right.
could never go out 20 years on a regular conventional
And
loan.
it's fixed.
Yeah, well, the way
Their portion.
their
right?
portion is fixed.
We'll go into that again, yeah.
Yeah,
So their portion is 50%?
It's 50-40-10. The bank does 50%, and that's one thing that makes it attractive to the bank because we have 50%, the first lien, over the whole project. The
Yeah, so
SB
if it's $1 million, you might have $500,000
Right.
and you got $1 million collateral.
That's right.
That's pretty cool.
And then the 40%, the SBA has through what they call Capital Certified Development Corporation. There's various CDCs that are in town that run that, but it's all through the SBA.
Gotcha.
And the way they do the way their pricing is so cheap is because they sell debentures on the open market at the time of closing. So the
Where
rates.
the market is at closing?
That's right. That's right. So you may have an initial rate right now. I think right now a 20-year fix is at 4.66 today.
Never thought I'd see that in my life.
Yeah.
So I'm going to fix 40% of it at
4.66 for 20 years. Yeah.
It's a no-brainer if you have a building that you need to refinance.
Right. But on the SBA side, though, there are fees. Okay, now
Right.
those fees are, sometimes people look at the fees and are like, wow, but they're all those fees are rolled into the loan. But really, you have to look at it long term because those
Right.
fees are made up. Because otherwise, if you went on conventional loans, first of all, no bank is going to give you a 20-year fixed rate. So
What are
you're
you
going to have
doing
it just
on your 50%? What are you doing? A 5-year fix?
5 years.
And the interest rate isn't 4.
No,
4.6.
no. Well, depending on the strength of the individual, you're looking at, let's say on a conservative basis, this is without looking at numbers, I want to say, 6.25. Okay? And
Still
even that's
looks
not
great.
bad. That's
Yeah,
still
that's
a pretty
good.
good rate.
Yeah.
So if you look at it from a blended perspective between that and the other rate, you're looking at maybe at 5.25 that you're, between both loans.
Which is great.
Yeah, it's a darn good loan.
Yeah, that is. That's fantastic. So, and that makes a lot of sense there. What about working capital loans?
Working
Right.
capital too, and those typically are term loans.
Line of credits, working capital. When I say it, I almost say it like they're the same, but to you, they're not the same.
No, okay. Working capital is, you can actually do structural part of the working capital let's say, for instance, let's say you wanted to free up some debt, or maybe let's say you wanted to use some of that working capital to make payroll to cover those expenses. Well, rather than put it as a line of credit, because see, this is the other thing is, if you do it as a line of credit, you want that line of credit revolved. If you can't revolve it, then it's better to term it out.
Gotcha.
Okay, that's where the difference lies. But
I gotcha.
But on short-term working capital needs, that's receivable financing, that's inventory financing. These are assets that turn within a year, and so that way, that's where the line of credit revolves. Okay, where working capital, if you were gonna, as an example, like we do put working capital as far as on startup loans, because we recognize that if you have a business that's gonna, let's say, have leasehold improvements, they're gonna buy equipment. Well, they're gonna have to, make payroll and some of the other expenses for at least 4 to 5 months. So they can include that as part of the term loan, which in there is broken down under working capital. So now under the SBA loans, they're going to want to say, if they say, okay, they want to come to you and say, okay, I want to borrow $400,000. Then our question is, okay, what are you going to use that $400,000?
Right.
So if they're going to start their business, they may have a retail space that they want to go ahead and lease. So a portion of it may represent leasehold improvements, a portion may represent equipment, and then, such as computers, point of sale equipment, and then let's say they need to have working capital. That's one thing we always tell the business owners to look at, because they've got to make, once those doors open,
You got overhead.
yeah, expenses start rolling in.
Yeah.
You know,
Yeah,
you got
overhead.
insurance, rent,
Yeah.
and rent can be
Payroll.
part of working capital, payroll. These are expenses that that meter starts ticking once
Yeah.
that door opens.
So you got overhead every
Right.
second of every day.
So you know they're going to be in the red.
Yeah.
So what they
Until
do
they
is
start getting customers.
right, and that working capital is it's not going to be a blank check giving to them. They'll have that. What we would do is that particular loan would be say 6 months of interest only,
Mhm.
and they would build up to the loan amount. So let's say, for instance, they do the leasehold improvements, they
That's
buy
it.
the equipment, whatever.
Mhm.
But let's say now there's 60,000 still available.
Mhm.
Okay, so for working capital. So now they'll come each month and say, okay, Ray,
I need a draw.
I need to draw. Yeah, I need to pay payroll. I need to pay rent. So
Mhm.
there they go. So it starts until 6 months. By that time, they'll have used all the funds, and hopefully within that time, now they'll start
Built up
generating.
their customer base.
Right. And now they'll start. We'll see their break-even point, and then we'll see where they start actually generating revenue.
Now, obviously, I'm assuming you're a lot stricter on startup loans than somebody who's been in
Yeah.
business for 5 years.
Well-
what are you looking for in somebody that's a startup? I mean, everybody's got an idea. You need more than an idea.
Well, and the other thing which I haven't mentioned too, and all of this is going to be injection. You know, the bank and the SBA, we're not going to finance 100%. Okay, so
Okay.
depending on the industry, you may be looking at injection anywhere from say 15 to maybe 35%, depending on what it
You're
is.
looking, and you're also probably looking at credit worthiness.
Oh, absolutely. Yeah.
Past experience in this industry.
Right.
I'm assuming you're looking a lot. If somebody's in business for 5-6 years, they got a track record.
Right.
If I got somebody who gets a bug and decides to open a bar, you're gonna have, I hate bars. I have some bar ownerships,
Right.
but I tend not to take them because as clients unless I see that they've had experience.
Right. Well,
They're
then-
doing the same kind of thing.
I
aren't
think
you?
you've hit the nail on the head, because let me give you an example, okay? Many times business owners get complacent, and what they'll do is they'll have one main employee that
Mhm.
runs the operation.
Yeah.
I mean,
See
they're
it all
doing
the
everything.
time.
I mean, they're real smart. They know what's going on. And all of a sudden, someone plants that bug in their ear. How come you're not starting your own business? Why aren't you? You're the one that's running the show.
Uh-huh. Yep.
So what happens is sometimes that individual may go to the owner and say, hey, you know what? I'm running the show. Why don't you sell me an interest in your business? And they say no.
Mhm.
Well, then that's when the wheels start turning.
Mhm.
They'll go and start their business, and by that time they already know all the customers, and the customers say, well, I'll follow you because you're the one
You're
that's
the one that's been dealing with me
Right.
all this time.
So
Yeah.
that's what happens. They start their business, and now they already have a following. So, and that's part of the business plan, because they'll come in and say, you know what, I've dealt with XYZ company, so and so and so, and they're willing
Yep.
to start coming with
I
me.
have a client exactly along that lines. Two guys, they ran the business. They ran this restaurant for the last 5-6 years. They're the only ones there. I got absentee owners. They want to buy it. The owners don't want to sell it to them. They're going down the street getting financing, and that's why.
Right.
Exactly what you're talking about. In El Paso, we've had a large influx because of Fort Bliss, and construction's a big area. And I wanted to make sure I talked to you about contract funding, because a lot of people don't understand that. What I see a lot of times is that somebody will get a $100,000 contract, and they get $50,000 worth of cost in this thing, and then they did a good job, so they get a $250,000 job, and then they survive that one, and also they get a $500 million job, and that growth just eats up their working capital.
Mm-hmm.
And you've got a pretty cool product as far as contract funding that really helps that. You want to explain that a little bit, because I think a lot of people might fall into that category.
Well, it's called a cap line, and
Okay, I called it a different thing.
Right.
Okay.
but it requires homework from the contractor owner. I mean, he should know his business. I mean, when he goes out and bids a job, he knows what his cost into that job is, and also the other thing is he knows when that contract is to be completed. So let's say he's awarded a contract, and that contract is
And
to
if
be
he
completed.
doesn't know, how many times do you run into people
Well,
that don't know?
see, then that's the red flag.
Yeah.
Because if he doesn't know his cost, if he
Doesn't have good accounting records.
right,
Yeah.
well then that's
done.
Yeah,
Yeah.
So
So really, from a bank standpoint, you're done if they don't know their numbers.
all right, absolutely.
Which makes total sense to me.
And when we'll find that out is when I'll come back and say, okay, you know what? I want to see a schedule.
Schedule
And they're like, well,
payments.
Well, the schedule of the work, a work in progress.
I gotcha. Okay.
So, and typically, a lot of some depending on the contracts, sometimes the contracts will allow them a little bit of money up front, and then what I want to do is I want to see their cycle. Okay, so when
What do you
they
mean by cycle?
well, their cycle as far as and relating back to the schedule is okay. They start doing the work. Okay, so let's say and their job may be broken down into 3 or 4 phases.
Gotcha.
And under those phases, when are they going to bill?
When
and
they
what are
do
they going to
progress bills and when
Right.
they get paid.
Now, all that should be written in the contract.
Right.
Okay, and of course, even the other thing is change orders.
Mhm.
That's also very important because if
That can be huge.
because if it's not written in the contract, about allowing for change orders, and all of a sudden the owner comes and says, "I've got a change order here," and he expects that contractor to eat the cost.
Mhm.
Well, there goes his profit. So you have to really look at that contract and see how it reads.
Mhm.
But really, that contract should spell out how the performance of that contract over 6 or 7 months, and then talking about the retainage, because typically the retainage is their profit.
And well, that can be 5 to 10%, right?
Sure.
5% is typical government, 10% is typical normal, and that could stay. I've seen it stay 2 years.
Yeah, that's
or
right.
longer.
That's right.
And that could be their profit margin.
Right. That's exactly.
So what basically happens then is they bring the contract to you, and they basically bring you what? I mean, they bring you the contract. You fund it. How do you fund it? Is what I'm getting to.
Okay, as far as the funding part, the way that works is we'll see the contract, and typically they have to put in their work into it, and typically they're working with other subs.
Mm-hmm.
You may talk about grading, you may talk about doing the dirt work, and then comes the concrete framing, things of that nature. So as they're doing that work, then what happens is they'll come in and say, okay, I need to get a draw so I can pay these guys. Well, then we'll go and check, or we'll have an inspector see that work has been
So
completed.
you actually go look.
Oh yeah, absolutely.
Oh.
You have to. You have to.
Yeah. And so when the customer pays, when the general contractor sends a check to this guy, assuming it's not the general contractor, the check goes to them, goes to you.
Well, there's also I've dealt with this recently, and this is actually pretty neat. Is sometimes these contractors have to get bonded.
Right.
Okay.
Normally.
So what the bonded company will do is say, we'll bond you, but we're going to manage we're going to manage the payment. So
Really?
when they get paid, we send the payment to the bonding company, and the bonding company pays all the subs.
I have not seen that
Yeah,
yet.
I've
Is
seen
that
that.
something new?
I think what it happens is the bonding company's
Or
doing
getting
that
paid.
so they can not only protect themselves, but so they'll insure that job.
Yeah, because a lot of times what will happen is that the subcontractors aren't getting paid.
That's right.
And
That's
they're
exactly
They're
what
putting a lien on the contractor's
Right.
lien on the building, which makes it almost impossible to get financing. So then the owner's going back to the bonding company saying, "Hey, I can't finish."
Right. Right.
That's pretty cool. What's the difference between what we described as contract funding and receivable funding? Do you do that?
Yeah. Well,
And
the difference on that
receivable
is
funding, aren't you really lending to the customer? You're lending based on my customer. If I have a customer like the El Paso Electric Company, and my credit, I may be new, but you know you're going to get paid from them. That should help, right?
well, yeah, but the difference between what they call asset-based funding and contract funding is if you have a receivable for an actual service or product sold.
Mm-hmm.
So in other words, if you do a service, let's
So
say
even services you can do.
right. So let's say you have and it may be the terms. Let's say, for instance, you have someone that cleans windows, and their agreement between this, and you have a lot of service companies do service maintenance, and they have agreements with these companies, and the agreements is, we'll pay you within 30 or 45 days, okay? But in the meantime, these companies may be growing and they have other jobs, so basically their money's tied up in receivables.
That's right.
Okay, so the receivables are actually work or services or actually a product sold that has actually been completed.
Mm-hmm.
Okay, now the difference from contract financing is it's ongoing. Contract is not
It's a
completed.
particular contract.
Right.
And once that contract's done, are you done? Or
Yeah,
yours has an umbrella sometimes.
Right,
don't
under
they?
this program you have an umbrella, and so what you do, you can run multiple contracts.
So I might have a $500,000 line of credit, and I might run 3 or 4
That's
jobs under that.
Right.
But whereas with receivables, do you set a limit? on the
Well, there's a
receivables?
borrowing base.
70% or
Yeah.
60%? How's that determined?
There's a borrowing base where they'll look at 80% of receivables that are 60 days and under, and then the other thing too is to protect us and the customer is a concentration. If they have basically the proverbial too many eggs in one basket,
You have 1 or 2 customers instead of 50.
that could be very dangerous.
I had somebody a few years back that I called in, $900,000 in sales, all but 2,000 to one customer.
Yeah.
And I kept telling them, making money. And then, of course, the economy turned, and they brought that job in house, and he doesn't have a business anymore.
Yeah. Well, and we had a builder that came in. Not a builder. He manufactured doors, and his 85% of his customers was to one builder.
Oh.
And then he had a few. And what he wanted to do is for us to finance his new building. Yeah. Well, we were very scary about that because
that's not a business.
Yeah.
I tell my clients that's not a business. You got an outsourced job.
Right.
Right?
Yeah. And what happened was when the economy turned, the sales plummeted.
Sure.
And
he's got nothing else to fall back on.
Yeah.
That's why one of the things I'm always talking about is one's a bad number.
Right.
In business, one's a bad number. Difference between receivable financing and factoring? People go into factoring. Why would they rather go to a bank?
Well, first of all, factoring is very expensive. I used to do that when I was with another bank. It's good for those that are not eligible for.
It's big in the trucking industry. Why?
Yes. Well, because first of all,
tradition.
Well, because they're much more riskier because you're dealing with. Really, the main kicker on this is the fuel cost because, especially with the customers, because the fuel is so volatile that
the profit margin can go like that.
That's right. And the thing is that the customers typically will hold on to that price as long as they can, even though fuel prices are going up.
Okay.
And the same thing even when fuel prices.
So that's why it's in some industries. But like you're saying, I'm better off going to you because I'm going to get less fees and a lower interest rate rather than factoring. Is what you're basically saying.
But you understand this, okay? Factoring does serve its purposes, and there's some times where the bank can't do it only because, especially when the businesses are relatively new. Okay, so I'll give you an example. We had when I was with another bank, we had a company that was doing sports apparel, and they had literally hundreds of little customers that were buying.
But they were wholesaling.
Right.
Yeah.
They were manufacturing. Soccer uniforms, baseball uniforms. I mean, all over the country.
Doing special runs on everything?
Yeah.
Oh my gosh.
So because of that, we had them on a factory program. Now, the thing that benefited us is because the bank had control of those receivables. That's where the difference between the traditional line of credit and factoring, because the bank has control of that receivable. So what we do is we would get a letter from our customer to their customer saying, okay, we're going to be providing the working capital for these particular receivables. Those receivables belong to us, so they have to come directly to us in a lockbox. Gotcha. But also too, it is costlier because typically there's factory companies range anywhere from 3 to 8% upfront the fee. Okay, so for every $100 receivable that you bring in, you'll pay that 3 to 8% fee, and then in addition to that, typically most factoring companies put a reserve. Anywhere from 15 to 20%. So based on that, you're actually maybe getting 70% of that receivable.
And that reserve is in case they don't get paid.
That's right. That's right.
The customer. So you're only getting 70%. You're paying high fees, but it serves a purpose in some industries.
Right.
It's the only way they can survive.
Right. And then on top of that, this is where how expensive is that that meter is running from day one. So if you and you have to read the language very very thoroughly because. Typically, after 30 days, they start upping up that fee.
Oh, really?
Right.
It'll change.
Yeah, and then sometimes...
I don't think I ever looked at when that closed because I haven't been in the operations in that area.
Right.
So typically, it'll have a different fee based on how old they get.
Right, and then if that particular receivable, depending on what industry it's in, is not paid within 60 days, then you have to buy it back.
And you get hit your reserve.
Right.
And if your reserve goes negative, you get cash. You don't get funded for the next couple.
So basically what happened is on that receivable, you've lost. You're now in the red.
Yeah, and typically what I see the problem with factoring sometimes is once you get in, it's almost impossible to get out. You got to be real careful. Your business better be growing.
Right. Yeah. Well, but you know what? If you're in a way to where you've got good receivables and they turn and they pay and that bank is collecting, number one, it's going to minimize your costs.
Right.
But if those receivables are being collected by the bank, then that's better for you. And then what will happen is at some point, that's when you graduate from the factoring. That's when you should be able to go to a traditional line of credit.
Yeah. And kind of summarizing what we just talked about, I think it goes back to what you said at the very beginning. We just covered maybe 10 different loan products.
Sure.
You really need to get with the banker to match the right product with your need.
Right.
Early in the process.
Right.
And
Now,
not wait until the worst time to try to get money is when you need it.
Right.
Well, there's a reason for it. It takes time to match this process.
Right.
And waiting until you need it is kind of sending a message to the banker, isn't it, that you don't know what you're doing.
Right. Well, and let me interject on something which I did on the line of credit. When you have a line of credit, as I mentioned, it's for short-term working capital needs. Okay, so now let's say, for instance, you have a seasoned company, great company. Okay, has good receivables. You know, they turn. Now, typically, on the way I see on lines of credit, it's basically kind of like on the honor system. You bring us your receivables, and the receivables are great. Let's say, for instance, 80% of your receivables are 45 days and under. Okay, very small portion of 60 days, maybe 5% that are over 60 days.
Okay.
So we've got a great picture. We've got a company that's making money, doing well. Okay. So now he's using his line of credit to help his working capital.
Gotcha.
Okay. This is sometimes where we have a problem. Okay. Is the way they need to approach that is keep in mind is that when they're using our line to fund their short-term capital needs, which could be payroll, whatever expenses, as soon as they collect those receivables, okay, they need to pay down on that line.
At least something.
Right. Because what happens on many occasions is that these people will take their profit, or which should be applied to our line, and they'll go buy equipment. Okay. So now what happens is those monies that should have paid down those receivables are now invested
Tied
in
up
equipment.
somewhere.
That's right.
Yeah.
So now they don't have that ability to pay down that line.
Yeah, you kind of led somewhere else, and it really wasn't on my outline, but, you know, don't ignore the banker when things go bad.
That's right. That's right.
What do you, can you help them, or what?
Well, like on that receivable, that's why we
Yeah.
get borrowing-based reports, because we ask for them monthly, and we look at their collection process.
Let's say a client hits a bad spell for 6 months. They need to come see you, especially
Yeah.
if they can show that it's something.
Sometimes it's
contract
not
that-
in their control.
Right. I mean, like the one we were talking about earlier, where Medicare changes their rules.
Right.
I mean, that's something they need to come see you, right?
Right.
Or a contractor where the general contractor goes bust, and now this job's taking 6 months while the bonding company steps in.
The
You
mistake
go-
is not to hide from your bank.
Right.
You know, be forthright and say, look, we've got a problem. And the bank can help in many ways, and these people don't know. Sometimes you could put the loan on a moratorium for
Interest only.
yeah,
maybe?
interest only, you know, for a number of months, just until. But with that said, let's say the owner has a plan to get back on his feet.
There's the key.
Okay,
Better
yeah.
come with a plan.
Right. So and that
You
makes
guys might be able to help them.
Sure,
because
sure.
This isn't your first rodeo. I'm sure you don't bat 100.
no, not and especially in today's environment.
Yeah, so I mean, you've run into before
Sure,
where somebody's actually had a problem, and you might be a great resource. Like, okay, I've seen this. You need to think about this. Go see this person.
Right.
Go get help here.
Right.
I kind of put together, and I don't want to waste a lot of time on this, but I want to put this on the new look forward. It's going to be a PDF of what you would expect, and it's kind of in the yellow section down here. I put these are the kind of things that they should bring, right? I mean, I got financials for the business plus for the personal. You usually run
Right.
it.
Personal finance, right?
Normally, you ask for 3 years back.
Yes.
All right. Projections, do you need those all the time, or is that just on new businesses?
That's more for new business, but really if
or an expansion?
yeah, that's right. But you know what? If you have a seasoned business that's been for 3 years, projections
yeah.
aren't going to be a problem. I mean,
Right.
they are.
Piece of cake, actually. I can do a budget that's when they're new. It's
Yeah, that's kind of.
I can project anything forward if you can tell me what the sales are going to be.
Right. Right.
No problem I always have with the new businesses is what's the sales going to be?
Well, and that's the problem because we
Yeah.
see a lot of pie in the sky with
Lord Almighty. Yeah, my own personal experience, and you probably can agree with what you've seen, is everything takes twice as long and costs 3 times as much, or the other way around.
Right.
Of what we think. As entrepreneurs, we tend to be very pie in the sky, optimistic, rosy,
Right.
glass is full.
Right.
Never mind half full, it's full. And we're all guilty of that. Tax returns for everything,
Yes,
if it's a
corporation.
corporation, personal, all the players.
Remember, we're going to look at this from a global standpoint. We need to, just because we're looking at the business, you got to remember that the livelihood of these individuals come from that business. So whatever they're taking out of that business is
There's a
servicing.
drain on the business. Right?
Yeah. Well,
Not necessarily drain might be a bad word, but it's
Well,
using cash.
right. That's exactly right. And you know, and where you kind of see red flags sometimes when people do that is typically you want to see them the monies they're taking out of the business to fund their livelihood.
Mm-hmm.
Okay, but then sometimes you look at other things and you find out, oh, guess what? They bought the house in Rio Doso.
Or they got the $100,000 BMW.
Yeah, or they have a number of cars. Then that's when you're looking at these things and you're like, you know.
We joke here, there's always a business that struggles for 10 to 15 years, and then I see them drive up in a BMW. And
That's
my
right.
first thought is, I hope they put some money aside for taxes, because they don't think. They don't realize they've been doing it 10, 20%, but we don't live in a flat tax world.
Yeah.
So you're saying the same thing. Obviously, they need to be prepared to tell you what they're going to use the funds for, right?
Right.
And if they don't know that, how many times does that happen? I need a loan. You ask them what they're going to use it for. You get people that don't know?
Right. Yeah.
That's scary for me
it's
to
a number
even
that
imagine.
they pick out of the
I don't
thin
know,
air.
100,000?
Yeah. And then the other thing too on that, well, on the other side of the spectrum is, when sometimes when they pick a number and then they'll say, well, should I go a lesser amount so I can get the loan? And I'm like, no, you need to get the money that you need to get this business going. I mean, just to
you're going to approve the loan based on whether it's a good idea or not.
Right.
Based on what you say you need, but you're going to use common sense too.
Right.
I mean, if you look at somebody that says they're going to open a restaurant for $50,000, you know
that's not going to happen, right?
I'm using that as an example because we're probably talking a couple $100,000.
Sure.
Easy, right? Mm-hmm. Probably more. Regulations, resumes for everybody that takes part of it.
Right, and that's where
Are we talking about investors, or are we talking about people that are working?
Well, it all depends. You may have a partnership coming in, and you may have one that's just a silent partner that his purpose is just investment.
Give them money.
Right. And of course, too, then the other thing is to find out what his involvement is, and it may be none, but his support may be from a financial standpoint, and that's good, because like as I mentioned, the bank's not going to do 100% of the loan. Now, then comes the other partners where you may have an individual that is the main guy. Okay, so he's the one that's going to run the day-to-day operation, and he may know maybe the accounting side. So they may complement each other.
Right.
You see a lot of, and you probably know, a lot of husband and wife teams that run
always.
businesses. So
I always argue good businesses have an inside-outside personality. Somebody who's out getting the customers, making sure the work's delivered, and somebody that's paying the bills and making sure everything happens correctly in the office.
Right.
And it's often a husband and wife team.
Right. And see, this is where I've always said that a business needs to align themselves with his banker, his accountant, his insurance agent, and his attorney.
Yeah.
Those people always come to play at some point. And
So
as an example,
always.
and as an example for that, when you're talking about insurance right now, is if you have one main person that runs business, we're probably going to ask for life insurance.
Key man life insurance, because for me, if I'm not here, this business is
that's
gone.
exactly.
That's why we went out and bit the bullet and got a big life insurance, because I want to make sure people are taken care
Sure.
of. And I'm not a fan of life insurance, but that's the place that's needed.
That's a reality.
And if you have a loan, you guys need to make sure you're getting paid back. And
Yeah.
if the main guy that has the vision, the drive, and has the customers isn't there, that's your way of getting paid back. I didn't even think about that.
And we also look at, just as a little caveat to that, is especially with doctors and professionals, we also look for disability insurance.
Yeah, okay.
Because their hands are their livelihood,
Sure.
and you never know.
I could run my business out of a wheelchair.
Sure. Yeah.
The surgeon, I don't want them to have their hands gone.
Yeah.
That pretty much put them out. Collateral, they should be prepared, or is that something you look for?
Well, the collateral, understand this: collateral is not going to repay the loan back.
No,
Okay.
no. A lot of banks found that out the
Right.
hard way, didn't they?
Right. Unless you have it cash secured, but for the most part, collateral isn't going to. It's just more of a buffer. I mean, it reduces the risk, but really minimally. But we're going to be looking at collateral, and most importantly, that's usually part of the loan proceeds.
Right, and then the biggest thing I put down there, they got to be able to show they have the ability to repay the loan.
Right.
And that's what you're talking about, pie in the sky numbers and experience, and all this kind of ties together. Really, everything we're talking about is convincing you that they can repay the loan.
Right. Right.
And you want to make loans that help people, but you're not in the donation business.
No. And see, this is where the important part is, because let's say, for instance, someone has their job and they're drawing a nice salary, and now they want to start this business.
Yeah.
Well, and this is where some of the planning comes into play. Is if I'm going to start business and I know that I'm going to be drawing off a certain income, and I'm not talking about within say 3 to 4 months. I'm talking maybe even further. What I would start doing is I would start paying off some of my bills.
Oh yeah.
my credit cards, try to get my cars paid off, and run lean and mean, so that by the time I'm ready to start the business, I may be let's say a one-man operation, or maybe a five-person operation, but I'm the main guy. Mm-hmm. Well, my salary is going to be derived from that business. Mm-hmm. So I need to run it as lean and mean as possible, right, because you want to make sure reinvest back into the business. So if on the livelihood side, you have very minimal debt, well then that only makes it that much better.
It makes it much better. Is there anything I left out that you'd like to see from the yellow, or that pretty much covers everything you're going to ask for, isn't it?
Yeah, it pretty much, I think we covered all the bases here.
Anything that you think I should ask that I didn't ask?
When you ask about resources, are there resources for them to get educated on this?
Yeah, all right.
And the answer is yes, there is.
You mentioned SCORE once.
SCORE, you have the community college.
A lot of them have, ours does, and a lot of them now have entrepreneurial centers. Mm-hmm. And a lot of courses that they're doing at night or at home, right?
Right. Both the Hispanic and the Chamber of Commerce.
So check your resources there.
Yeah. Well, I'll tell you, the I don't even know if you even know this, but the Chamber of Commerce has, it's called the Business Information Center.
I heard it. I haven't been involved with it.
Let's say, for instance, you wanted to start a business, mm-hmm, but you didn't know, let's say you're retired military.
Yeah.
You've got a nice pension. You've saved up some money.
Mm-hmm. Thinking about.
Yeah, I want to run a business.
Right.
What do I do? Don't have any experience.
Yeah.
Well, at the Business Information Center, they have information on all sorts of industries, franchises, mm-hmm, businesses out there, and of course you have to do the homework. But at least you have a place to start. You can go through business, and you're going through all these type of businesses. Hey, I can do this. Mm-hmm. And then that leads to, okay, I want to start the business now. What do I need to do? How do I go back and start getting the mm-hmm, education? Well, you know what? I'm probably going to need to know some type of accounting, QuickBooks or whatever.
Right.
Okay. What about marketing? Well, the community college has marketing classes.
That's right.
Okay.
Yeah.
I'm going to need a lawyer to. What do I start off as a sole proprietorship?
Right.
Do I corporation? What?
In today's world, there's no excuse.
Right.
I mean, we're living in an information society. You can
right,
Google just about anything. You can educate yourself on anything if you go look.
Right.
And it's just too many people just say, "I'm going to open the doors."
Right.
And that's why you have an 80% failure rate.
And
right?
then that time also.
Oh,
okay. I don't think we talked about this or touched on it. And the last thing I would want to say is, you better be ready to put in your cash into the business.
Yeah.
Okay. That's really important.
They don't have to.
Yeah. Because you know what, the rule of thumb on that is the more cash you put into the business, the less likely you're going to want to walk away from it when things get into.
That's a good point. Yeah. The more you got skin in the game.
Right.
Basically. Right. Pretty much covered a lot, and I want to thank you for your time. Appreciate it, Ray.
Okay. We would like to thank Ray Aguilar for his interview. If you are interested in contacting United Bank, visit unitelpaso.com or call 915-231-2500. Thank you for watching.